For more now on the contagion risk, we're joined by Alberto Gallo, Algebris Investment Portfolio Manager, Lefteris Farmakis, UBS Global Macro Strategist. Alberto, let me start with you. How important is what we're seeing in emerging markets right now? We have the Argentinian peso. Nobody's got a mandate to touch it. You can't. Nobody trades the Argentinian peso. You've got, to Tom's point, the Indian rupee is important. There's a very big economy, and that's been weakening. But the data doesn't kind of stack up against that. The rand, hard to trade. So how important is what we're seeing in emerging markets to the global economy?
Investors have put money into emerging markets over the last 10 years because of a very easy environment for financial conditions. So we now are witnessing a reversal of this 10-year trend of inflows. The difference, though, is that you now are starting to have tighter financial conditions with the Fed hiking. The debt imbalances which caused the crisis 10 years ago are still there. In emerging markets, they're actually larger in some countries. And the third most important difference is you have populism. You have leaders that are convincing their electorates that growth can continue, that infrastructure spending can continue, that they can reallocate land. You have polarization. Think about the President Erdogan, for example, with infrastructure and construction as 10% of GDP. The reallocation of land in South Africa. The Brazil election, where you have a right-wing and a left-wing populist potentially going into the second round, Mr. Bolsonaro and Mr. Haddad. So the populist trend is what provides an extra catalyst for these markets to reprice. Valuations are still, obviously in Turkey and Argentina, which are the weakest countries from a current account point of view, have already repriced. But valuations elsewhere in the EM world are still around long-term averages. So we don't think this is over, especially on the bond side.
Okay. Lefteris, Neil Kashkari, Minneapolis, yesterday, he's concerned. He's a little worried. He thinks that Turkey or something like Turkey could be a spark that kind of feeds back in to the US economy, which is roaring ahead at the moment. Does this, what goes on in EM, stay in EM? Or does it start to bleed into other economies as well?
Well, it's a recurring question. It tends to happen every now. It tends to re-emerge every time that there seems to be turmoil in emerging markets. So we have to look into the linkages. On the one hand, you have the, let's say, easy, intuitive contagion channel, which is through confidence and which probably takes more to be disturbed and actually tighten financial conditions even more in the rest of the world. And then you have direct linkages either through the banking system or through some sort of exposure to bad debts here and there. That doesn't seem to be particularly large at the moment. But on the other hand, this remark from Alberto earlier, the search for yield in the past has actually generated significant inflows into emerging markets. Yep. As this unwinds, it's normal to actually see sort of tension in emerging markets extend, even if the discernible direct linkages are not particularly large.
Alberto, I want to go into what you just mentioned, which is a linkage of all this FX back and forth over into bonds and then as an inflation indicator. Let me, for folks, bring up where you go when you have a weaker currency. In this case, it happens to be Turkish lira, a chart we've shown many times, which is the bonds within Turkey. One is in Turkish lira, up here 20-some%, 23% right now. And you can see on a log basis this huge move in their dollar-based yield up to 9.60%, breaking out to new highs. Is this all acting, Alberto, in a normal way, or is there something distinctive and different this time, the linkage between FX, yield, and inflation expectations?
So Turkey is a case of a private debt overhang. Government debt in Turkey is not very high, but private debt, especially foreign currency denominated private debt, is very high at the corporate level, including SMEs, which in turn spills over to the banks. So and let's remember the president's strategy over the last years has been to boost infrastructure and construction investment with bank lending and also a lower interest rate for domestic firms. So what the central bank in Turkey hasn't been doing to defend the currencies is they haven't been hiking rates. So inflation, forward inflation is above 20% now, and it's been let go much higher. Now, normally you would say that in a currency depreciation environment, exports would help you. But the reality is that in most of these EM crises, eventually you need to hike rates. You're going to have a domestic credit crunch, and you also will have to reduce the current account deficit by cutting imports by a large amount. It can be between 1/4 and 3/4. So you have to go through a lot of political pain as you cut imports, do fiscal austerity, and reduce the current account deficit. And that is what a lot of political regimes in emerging markets don't want to do, which is why things could get worse also before they get better.